So the old rule that we all know about is that dividends were good and salary was bad. That the analysis broadly stayed the same, but dividends are much better than salary, but we've got other things to think about now. And the reduction in the dividend allowance, although it doesn't change the analysis hugely, it does bring this into sharper focus. So I'm going to discuss the new rule. I have prepared this slide, and I'm going to explain it quickly first. So this slide assumes profit extraction on the basis that the amount paid out of the company is neutral. So the calculations are based on the premise that the net position of the company remains the same. So if you want to pay your employee £100,000, they will take home, and again, I've used the 2017 rates for this and bastardised them a little bit by putting in the £2,000 reduced dividend allowance. However, if you wanted to pay an employee £100,000, they would take home just under £65,500. If you wanted to structure it so that the cost of the company was the same, but the employee was paid through dividends rather than PAYE, but you let them have the £8,060 primary threshold salary so that they maintained a year for their national insurance contributions, they would end up with a net take-home of just under £73,500. As calculation takes into account the corporation tax cost to the company of paying it through dividend rather than salary, and it also takes into account the saving by paying it, the saving of the NIC. If you wanted to extract that money through interest, and again, these are extreme illustrations because the reality is you're going to end up with a mixture of all of these, but it does illustrate the point quite nicely. If you were going to extract it entirely through interest, you would be able to charge interest of £104,628. And that would give you a net take-home of £76,387. That's because it's deductible for the company, and you get your £5,000 interest allowance, and you'll also get another £500 interest allowance. If you were going to charge rent to the company, you could extract pretty much the same amount, but your net receipts would be slightly lower. And again, that's because of the £5,000 interest allowance that you wouldn't get if you charged rent. So the new analysis from that would appear that salary is still bad, dividends are okay, interest is good, and rent is good. But I alluded to the fact that actually the analysis is a little bit more complicated than that. Because, for example, if an individual reached state pension age, so they no longer had to pay their primary Class 1 national insurance contributions, immediately their net receipts would jump up to £70,800. And if you're in a situation where the company was making an R&D claim, which again I'll talk about later, for the net cost of the company to be the same, assuming that the individual in question spent 50% of their time on R&D, they would only take home £62,500. So you have to look at the bigger picture, you have to consider a number of factors. Other factors that you need to consider are, to be able to charge interest of over £100,000, you would need a huge loan. So it's unrealistic that you're going to charge that amount. If you charge market value rent on a property you rent to your company, you're going to scupper an entrepreneur's relief claim on an associated disposal later on. So again, that might not be the best way forward. But you need to take a holistic view of things, and it is no longer, I think, so clear as to say dividends good, salary bad. Right, Steve also said that I was going to talk about research and development. So I will. Again, this was only briefly mentioned in the budget, but this is what was said, that the government will make administrative changes to R&D tax credits to increase the certainty and simplicity around claims, and they will take action to improve awareness of R&D tax credits among SMEs. Now, this struck a chord with me, because on the one hand, I don't really understand how they can make the changes to R&D claims that make it simpler. To make an R&D claim, all you need to do is put the numbers on your tax return. What you should also do is submit an accompanying report that explains exactly what R&D has taken place. But how you can simplify it more than that, I don't know. I mean, you know your costs, you put your costs into your tax return, and you submit an accompanying report. I just can't see how they can make it any simpler. What was interesting is the fact they felt the need to talk about it. And R&D tax credits are underclaimed. The government accept this, the government keep on about it, they keep saying it, and when you talk to people, a lot of people don't understand that what they do constitutes research and development, which is why they feel the need to keep bringing it up and to suggest they can make it simpler and easier. If your company is innovative in any way, if it is a market leader, if you have a competitive advantage over your competitors, it would suggest to me that there's an R&D claim there. And R&D is fantastic. You get an uplift of 230% on your costs. You can surrender a tax loss for 14.5%, and that gets paid back to you. If you're a large company, you can claim an above-the-line tax credit, which appears on the face of your profit and loss if you wanted to. I mean, I was talking to a company that is based in Croatia recently, and they couldn't believe we had something like this. They're creating software for the banking sector, and they couldn't believe that we had such a generous relief. And it is just lost on some people. And the government want you to have it. This isn't like other taxes where they seem to be almost miserly in their approach, trying to collect everything. With R&D, they want you to have it. We have no issue getting claims to it.